Hello, my name is David Whyte. I work at the University of Liverpool, and one of the courses I teach is on how we research corporations. And this is really just an introduction to that course that goes through some of the jargon and some of the concepts that we need to know before we start the practicalities of researching corporations. And I usually do this course in conjunction with Corporate Watch, who are an independent research organisation. Check them out at this website if you haven't come across them before. And we collaborate on master's training, but also on a summer school that until COVID came along, we used to do quite happily and take people through practical exercises, sitting around the table face to face without masks on, that kind of thing that hopefully we'll get back to at some stage. And the first set of questions we really have to ask before we research corporations in any detail is just think about what a corporation is, what we mean by that. And originally it was an American term, really, but it's become much more prominent in this country to describe a business or a company, a firm. And I've got a couple of dictionary definitions. Academics love to give out dictionary definitions so they can shoot them down or say how much better their own personal definition is. And I'm not doing that here. I think these definitions are useful. The first definition identifies the idea that the corporation is established as a single entity, and I'll come back to that in a moment. But what we mean by that is, as an entity, it's different from the people. It has a separate status from the people that make up the corporation, whether that's the investors, the shareholders, senior managers, workers, and so on. And the second definition has a range of other features which are significant, and I'll go through in what follows. It has most of the rights and duties of natural persons, it has perpetual existence, and it has limited liability. Don't worry, we'll explain those terms. But the idea of the entity is the subject really of the first jargon busting term that I want to look at. The corporate person or corporate personhood is a phrase that you will hear to describe the separate entity status of the corporation. And really what this does, or what this indicates, is that the corporation has a separate identity, a different identity in law from the real persons, the real people that make up the corporation. Investors, managers and workers and so on. So the corporate person or corporate personhood is really a legal term that's used in other disciplines to indicate that the corporation is its own person, and that means that it has a range of rights and duties that are analogous to individuals in law. So, for example, corporations can claim rights under the European Convention of Human Rights. They can also be prosecuted in a court for violating a regulatory offence, for example. So those rights and duties are very often similar to the rights and duties that are owned by real people. And this works in law, but it also works in accounting. In the beginning of the 19th century, a kind of sub-specialism within accounting known as entity accounting emerged as a fully developed way of understanding how organisations' accounts worked, whereas prior to that, the focus of accounting would be on individuals, on real people. So the corporate person is quite significant, and it carries a number of advantages for corporations. That image in the last slide, by the way, is a share certificate, and it was a share certificate that entitled the bearer to a proportion of profits from a copper mine in Sweden, in a town called Falun, and the company was Stora Kopparberg, probably the first corporation recorded in this way in history. And that gives us a nice introduction into thinking about, well, what is a share certificate, and what does a share certificate do? And really all it does is it gives the owner rights to profit from the company, and it's often misconstrued as an indication of ownership. Strictly speaking, that's not the case, because when it comes to corporate personhood, as I've just said, the corporate person owns the assets of the company. It's the corporation that is the owner in that legal sense. And that's very important because that maintains a separation from the real persons, which give key commercial advantages to the corporations. It limits the exposure to individual investors. So if individual investors are not responsible for assets or liabilities, they're not going to be exposed to so much financial risk. It allows corporations to create complex structures, because very often one corporate person will divide its asset up through other and sometimes a very complex chain of corporate persons that has a very complex ownership relationship within the same group of companies or group of corporations. So that can effectively hide beneficiaries. It can bring other advantages, like it can allow the company to structure itself in the best way that limits its taxation liabilities and so on. And in fact, the whole point really of establishing a corporation was to give commercial advantages, particularly to investors, which would encourage them to invest and encourage economic growth. That's really the origin of the corporation. We don't have time to go into it here, but if we go back to the era of the colonial corporation from the 16th century on, really that's the point that we see very clearly, that corporations were key to the big processes of colonization, of land grab and of slavery, mainly because they gave commercial advantages to investors. So they encouraged the development of colonialism at a very rapid pace, and that's essentially still the same principle that's in force today. Corporations exist to encourage investment and give those key advantages, commercial advantages to investors. Okay, let's return to the phrase that was introduced in one of our definitions back in slide 1, this idea of perpetual existence. Now the images I've got in this slide are the images of the same company that I've just mentioned, Stora Kopparberg. On the left, that's a pictorial representation of the mine, I think from the 18th century. And on the right, there is the modern day headquarters of the same company. It's not called Stora Kopparberg anymore, it's called Stora Enso. And it's not primarily a mining company anymore, but primarily is a wood and pulp manufacturing company. So what's happened over time, and that share certificate that we saw dates back to the mid-13th century, dates back to the 1260s. Since then, the company has taken on a number of guises, and of course ownership of the shares have changed hands. But essentially, you can trace the lineage of the same company, Stora Enso, right back to Stora Kopparberg. It has perpetual existence. It doesn't die unless it's killed. And even in some cases, I mean, we those of you who are fans of Scottish football will know that there is a club that probably should have died. I'm not going to get partisan about this. I think it should have died, but anyway, I think it would be a good thing all round. But let's not create too much controversy. But Rangers Football Club, plc, entered administration in 2012, partly because of the debts it owed due to tax that it hadn't paid, and then was reinvented through a gradual process as the Rangers Football Club Limited. So it went from bankruptcy to a kind of rebirth. And one of the advantages of that process was that many of the creditors, particularly the smaller creditors, were never paid the debts that the original Rangers PLC owed. So there is sometimes life after liquidation. I think that's really important to note. And the key asset here that's common to both Rangers Football Club PLC and its latter incarnation as Rangers Football Club Limited is it still owns Ibrox Stadium. It still has its main asset intact. So there's a range of issues around the kind of perpetual existence of corporations, or the immortality of corporations, that are really important. And again, originally this was to protect the assets of investors. There are some histories which show that this principle was intimately related to the avoidance of death duties. When individual investors died, then they would be more exposed to death duties unless they could simply pass on, the shares were passed on or absorbed back into the company in some form. So that idea of perpetual existence is absolutely crucial, because it opens up other possibilities in terms of giving the corporation a separate personhood, a life that's separate to its investors and to its senior managers and directors. So we're going to deepen this analysis with the next slide and look at more clearly where the big advantages to investors that arises from corporate personhood. Limited liability, that's a phrase that we heard in the earlier definition, and very simply what it means is that investors' liabilities, their exposure to financial risk, is limited to the amount of money that they invested in the first place, the principal sum of their investment. So if someone buys shares in a corporation and the corporation collapses, their shares might become worthless very quickly, and that means they lose the sum they've invested, assuming the shares don't increase in value again, but they can lose the sum they invested, but that's really the maximum sum that they can lose. They won't be held liable for the losses of the company, and that means that they have limited liability. Now, what that means is their own assets are not affected, but the corporation's assets will have to be sold off to pay for losses, but not any individual investors. Now, there are some examples that we can find where the court has, in exceptional circumstances, lifted what's known as the corporate veil, but really it's very rare. And this veil is essentially the phrase that's used to describe the protection that investors have in this way. The corporate veil is also used to describe how directors and senior managers are protected, because they are not held liable for losses in those ways. There are some examples where directors, senior managers, where there is wrongdoing, they may be held liable in damages actions, or indeed may well be held liable in criminal court or for regulatory offences. But generally, directors, senior managers benefit from the corporate veil in the same way that investors do. So it's an important phrase to understand how the most powerful individuals involved in corporations are generally protected by the structure, by the very basic structure of the corporation, which starts, as we started, with this notion of corporate personhood. So finally, we're going to look at different types of corporation, the main types of corporation that we may come across in research. So as researchers, we're going to generally be interested in PLCs and limited companies, because these are the two categories that apply most commonly to large corporations. And I'm going to go through what we mean by those companies: public limited company, private limited company. This is where the jargon gets a little bit confusing. But let's have a quick look at why the difference is significant. And it is significant for researchers. There are similarities. Both are run for profit, both have shareholders. But shares of PLCs are bought and sold on stock markets. And the model for limited companies is different. Shares of limited companies are generally bought and sold privately. And of course, there are other types of companies. I note here about limited liability partnerships. But that brings a layer of complexity that we don't have time to get into. I do want to look at what the pros and cons. For researchers, there are some very kind of clear, if not huge, differences. But the difference is that PLCs have more reporting requirements. They have to publish more information for investors, so that informs investors' decisions on whether to invest or not. They have to have annual general meetings, so there's a higher level of accountability, and key decisions must be ratified by the shareholders at those meetings. So there is a flow of information which is a bit different from those companies, and that's a key advantage. Another key advantage is, of course, the company has access to more funds because it's publicly quoted on the stock market. You can raise funds more easily, but also it's more vulnerable to fluctuations in the markets, it's more beholden, if you like, to financial markets. So look, that was just a flavour of some of the concepts that you come across when researching corporations, and some of the concepts we need to get a grip on. And really this exercise was an exercise in jargon busting, in demystifying those terms as a kind of primer to doing this research. If you want to go further, and if you want to develop your interest in corporations, well, here's what to do. First thing, look out for the next NCRM event. There will be an event, hopefully both online and in person, and there will be summer schools starting up again. Depending when you're watching this, I hope there will be regular summer schools that you'd be welcome to join. But in the meantime, please check out the Corporate Watch Guide to Investigating Companies, which is free to download at the Corporate Watch website, and includes a range of tips on how you understand the company, how you understand company law, some of the issues that we've touched on in this video, a bit more of a detailed look at the types of company that you might come across, the way in which ownership in subsidiaries, parent companies works, and also the way in which you read company finance and company accounts. So please check out that resource. It's a great resource and it's free. And I hope to see you on one of our courses at some point in the very near future. Thanks for listening. Bye.